Hello and congratulations on taking the first step that you're going to need to do in order to become a profitable trader. So I'm sure before you even want to listen to me, you'll want to know what sort of credibility that I have with trading. So I've been day trading for 4 years. 2 of those years I wasn't even live. I was testing, doing back tests, figuring out what sort of strategy that I wanted, learning, doing education, and discovered that I could be profitable with trading. And so I actually took the leap and started using my own money. So since then, I've been profitable for about 2 years now, and I don't see myself going backwards at all. Once you kind of nail this sort of thing, it's pretty easy to keep up with it and continue to be profitable. So with this course that I've created, what it is it's the bare minimum basics of trading. So if you have absolutely no idea what you're looking at, this is going to be the course or boot camp, you could call it, for you. Now, depending how long the video is going to be, I might chop it into different parts, into different videos, so you're not sitting here for 2-3 hours. But even if you're an intermediate trader, you might find some value in some of the things that I teach in here. So let's jump into it and get started. So in lesson 1, what we're going to be doing is we're going to be looking at setting expectations for what to expect with trading in general. The reason why almost everyone gets into day trading is because you can live a life of financial freedom, you can be your own boss, and you can work from anywhere in the world. The thing is though, how many people can actually achieve that? And the answer is not many. And a lot of the time that's due to the incorrect information. So with day trading, a lot of it comes down to your current psychology. If you're under a lot of financial stress and you're, say, taking loans out from the bank to pay for your bills, day trading probably isn't going to be for you. If you're stressing about money, you're going to be risking more than you should be to try and catch those big moves and those big gains that are pretty unrealistic when it comes to trading. What I've done here is I've come up with a calculation that will give you realistic returns on how much capital you're actually using. For example, the average profitable day trader is making between 3 and 10% a month. 10% being pretty good, 3% being on the lower end of profitable traders. Now, don't let that discourage you either. I personally have had 20-30% months. I've even had upwards of 40% months as well. This is just going off of the average day trader that is profitable. What I want you to do with this calculation is I want you to figure out a number that you want to make from trading, whether that's paying your rent, paying some bills, going on a holiday, whatever you want. Doesn't matter, just pick the number. What you're going to do is you're going to divide that number by the 0.03 all the way up to 0.1. The 0.03 is representing 3%, 0.1 representing 10%. So that's kind of your expected monthly return. Now that's if you become a profitable day trader. Again, you can have those 40% months, so you can do those calculations as well. Give you a bit more encouragement, motivation, those sorts of things, because you can do those numbers. It's not impossible. So let's just say, for example, you want to make $1,000 a month, pay some bills, go on a holiday, something like that. You're going to divide that number. In this instance, it's 0.1, meaning 10% for the month, and then you will need $10,000 capital to be making $1,000 a month on average. Now, there's something else I want you to consider as well with trading and investing. So the S&P 500 has generated an annual return of 10.13% since 1957. Now, when you adjust that for inflation, it's only 6.37%. So if you even do one 10% month and then call it quits, you're ahead of most investors in general anyway. So there's one other thing that we need to take into consideration, and that's that 70 to 95% of day traders lose money. There's multiple reasons for why this is the case. A lot of this comes down to psychology, risk management, not having a trading plan. What I'm also going to do in this video is I'm going to give you a timeline breakdown of realistically how long it's actually going to take you to learn each step to be able to become a profitable and confident trader. So in lesson 2, we're going to do exactly that. You can increase these increments as well. So you can make it 6 months that you're doing the learning and education. You can make it 1 week that you're doing the education. It's very unique on kind of how you learn, how dedicated you are, how much time you have. This is kind of like maximum scenario of if I was to do it again, this is kind of what I would do. So what's the first month going to look like with trading? What we're going to do is we're going to focus on learning and education. Now, you need to be very, very, very cautious about who you're actually learning from. I've seen these trading gurus posting, hey, this person made $20,000 in his first week, and this person made £6,000 in his first week. It is complete bullshit. That does not ever happen, and you're better off going to the casino and throwing it on black if you're going to listen to someone like that. In your first month, you're going to be understanding the absolute basics of how the market moves, what it does, different levels that it usually reacts at, structure, things like that. It's all stuff I'm going to teach you. Another thing is you're going to have to learn what sort of tools you're going to need for trading, because it's not as simple as pressing buy or sell. There's a lot of other things that go into it. I'm not going to give you an information overload. We'll go over those later. So 1 to 3 months, what are we looking at? So when we have a small understanding of what happens day to day, how the market moves, different levels it reacts at, what we can do is we can start testing and demo trading, just kind of a few things, just get the feel of what it's actually like to day trade. So what's great about day trading and is kind of a negative about a lot of other niche side hustles is you can actually just test it all for free. Like, you can't really test how many sales you're going to get on a product. You can test how big of a return you're going to get on a certain strategy from the previous months, and you can forward test it. So you can start it from today and you can trade the strategy for 6 months before you actually want to go live, see if it's profitable, see if it's in the negatives, and just make sure that you're overall pretty comfortable with what you're doing before actually throwing your money in. Once we've had a little bit of a play around with that, we'll be looking at the 3 to 6 month period. So in the 3 to 6 month period, we'll be fine tuning what sort of strategy we have, our psychology, finishing off any forward testing in the market to make sure that our strategy doesn't have any flaws. And that's pretty much it. It's pretty simple. And then hopefully 6 months onwards, or if you're going to really lock in, you can make it 1 month. We're going to be putting our own money in and trading for profitability. Now, I want to mention something as well is that your psychology will change. As soon as you see real money on the charts, it's a whole different beast. We'll get into that a little bit later. So in lesson 3, we're going to be looking at candlesticks. So before we get into all the nitty gritty of kind of how a candlestick works, an entire candlestick is a representation of price movement during a specific period of time. So this candle right here could represent a hourly candlestick. It could represent a 5-minute candlestick, a monthly candlestick. It could represent weekly, daily, etc. So once we get into the nitty-gritty details of what a candlestick is, that will make a little bit more sense. So what we have here is we have the initial open of a candle. So let's just say the previous hourly candle has finished. This is where the price is currently trading from as the hour starts. Then when we go down here, this is the lowest point of the candlestick. Now this right here is called a wick. So basically what's happened is the price has gone down. It's opened here and it could have maybe gone up or down, something like that. But the lowest point within that hour it got to was here. And the same goes for up here. This is the highest point that it got to, and it's obviously gone down a little bit more, and then it's closed that hourly candle at this price point. As you can see with the red candle, it's the exact same. So with the colors, green usually means it's a bullish candle or an upwards trending candle, and it's the complete opposite for the reds. Down, bearish. Before we jump into the next slide, I want to give a few more examples of candlesticks and kind of what they look like on a chart. Might make it a little bit easier for you guys to understand what they are. This is a 5-minute time frame. As you can see up here, it's the pound US dollar cross. I'll explain that sort of stuff a little bit later. And it's on an M5, so minute 5-minute time frame. So each one of these candles represents 5 minutes of price movement. As you can see, opened up here. It's obviously going down. It's a bearish candle, and that's basically just how that works. Pretty straightforward. Okay, lesson 4. As you probably noticed in the last clip, not all candlesticks look exactly the same, and that can be a good thing because it can indicate sometimes which direction price is going to move in. So there are a million different types of candlesticks and patterns that you can use to somewhat predict which way the price is going to go next. These are just the most common ones that I would look for when determining what price might do next. So what we have here is what we call a spinning top or a doji. So what's happened here is the price has opened at a specific level. It's tried to go long, it's tried to go short, and then it's ended up at pretty much the same level that it opened at. So what does that mean? It means that the buyers have tried to buy and the sellers have tried to buy, and no one's in control right now. So it's pretty much at a stationary level, which can indicate a reversal. Let's just say that we're in a downwards trend. What's happened here is it's opened at a price. The sellers have tried to take control. The buyers have tried to take control, and we're in a bit of a neutral position, so no one's in control. What that can indicate is a reversal or a continuation to the downside. Not too sure, we're in a neutral position. Buying or selling from one of these candles is probably not what you want to do. What you'd want to do is wait for a little bit more confirmation. What we have here is a hammer or a shooting star. So let's just say we're in a selling market again. So we're in a downtrend, we're going down, and then here, these sellers have tried to take control and they couldn't make it happen. And what's happened is the buyers have started to take control. So that's when a hammer candle is formed. Now the same thing goes for the opposite. Say we're in a buying market, we're in an uptrend, and then we get to like a point of exhaustion, and what happens is the buyers keep trying to buy and the sellers try and take control, and then a lot of the time what you'll find is a reversal. These are just common things that happen in the market that you see frequently. This will just give you a bit of an idea of what to look for with different candlesticks. So what we have here is we got a 3-bar reversal. It's pretty straightforward. What we want to be looking for in a successful reversal in trend direction is we want to be looking for a big bullish or bearish candle, depends which way the market's going, that engulfs both the two previous bearish or bullish candles and closes above. Again, this is kind of just an indicator of where we would like to buy or sell. It indicates that there has been a break of structure, which leads us to believe that there might be buyers taking control in the market going in a certain direction. So I'm going to wrap that up as part 1 of the Trading for Beginners Bootcamp. What we're going to be looking at next is placing orders, what sort of order types there are, different types of levels in the market that we would be looking at to buy and sell, and a little bit more intricate details with that. Part 3 we'll go into after that, and then there might be another part that follows which gives you a little bit more advanced details into trading. I hope you've enjoyed, learned a few things, and I look forward to seeing you in the next part of the Trading for Beginners Bootcamp. Welcome back to part 2 of the Trading for Beginners course, bootcamp, whatever the fuck you want to call it. So in part 2, I'll be teaching you guys about different types of orders. I'll run through leverage and margin, and we'll have a dive into an actual chart and have a look at some different types of market structure as well. When you first hit the buy or sell button, that's just going to be your entry point. So that's where the broker decides to complete your order. Pretty much, it'll be pretty much straight away as soon as you hit that buy or sell button. It might be very incrementally different. We'll get into why that is and everything a bit later, but that is your entry point. So if you want to have protection for if the market is going to go down or up in the opposite direction of where you're predicting it to go, you will then put a stop loss in. So basically that will cancel out your order and basically just protect you from losing more money than you want to risk, essentially. And the same goes for if you want a take profit level. If you see the market might react at a certain level after putting in an entry and you want to take profits up at that level, that's where you'll be looking to put your take profit if you want. Again, we'll go through some strategies and stuff like that later. I'm going to give you a super quick example of how that works. So we will buy something pretty small. We'll go buy here. So our broker has filled my order just a little bit above. And if you want to take profit level, say this is the level that you think it's going to react at and then come back down, you'll put your take profit. So that'll give me $23. And if you think it's going to stop at about here, if you think that the price might get to there and you don't want to risk it going any further down, that's what, there you go. That was a big order that came down and it took it out anyway. So there you go. That's why I don't particularly like using stop losses, because that jumped down, took it out, and it could just continue to go up. You just never really know. Anyway, we'll get into that a little bit later. I just wanted to give you an example of how that kind of works with the buy, take profit, stop loss. Continuing on with placing orders, what you can also do is you can set orders in the future that you expect price to react at, and you can set those orders to either buy or sell. You can screenshot this if you want to. What I'm going to do is I'm just going to jump back to the charts. It's a little bit easier to explain. When I've got the charts in front of me, you'll see what I'm talking about in a second. So let's just say, for example, at this level up here, we expect price to react and go down. What we would do is we would right click, this is just for MetaTrader 4, we would right click and we'd put in what is a sell limit. So as you can see, I popped in that sell limit here, and what's going to happen is when price gets to that point, our broker's going to execute that order. What you can also do is you can modify it. So let's just say we wanted our take profit at 0.63126. 63126. And then we wanted our stop loss up at 63690. 63690. So what that will do is that will automatically put in our take profit and stop loss levels. So if it does hit that order, we still have the protection of taking profit, and we have the stop loss as well there, just in case we need it. So when we go down to the bottom here, we will also see a sell stop. It doesn't really matter because MetaTrader 4 automatically puts it in for you, but a sell stop is when it's below the current trading price, and what you're expecting is for it to hit that sell stop level and then continue going down. Now, the exact same thing is for buys as well. So let's just say down the bottom, we want to put a buy in, it will put a buy limit in. So it is reversed. So we've got our buy limit in, hoping that it's going to get up to here and then react back up. And the same thing at the top, it's going to be a buy stop as you're expecting the trend to continue upwards. So let's just say trading, buy stop. And then again, if you want, you can put in your levels that you want the stop loss and the take profit to be at. So that pretty much sums that up. It's pretty straightforward. I've got these points up here anyway. If you want to screenshot it, write it down or whatever, just so you got it in the back of your mind. But as I said, MetaTrader does it automatically, so you don't really need to memorize which one's which. Okay, so the next thing we're going to be talking about is leverage and margin. Leverage basically means that your broker will allow you to enter in with larger position sizes that you would normally be able to use with your own capital. Now, leverage is quite important when trading. You want to have as high leverage as possible. Most countries do have limits and caps on how much leverage they're able to access. I will go through that a little bit later with some workarounds for it as well, but get into that a little bit later. What we're focusing on is how leverage actually works. So let's just say your broker has a 10-to-1 leverage. As you can see here, it's quite a common thing that you will see these numbers, 100-to-1, 500-to-1, 1,000-to-1, 30-to-1, 1-to-1. So basically what that means is, as you can see for an example, 10-to-1 means that you can control $10 in the market with only $1. So that's great. If you say you only have $1,000 that you can use, you actually have access to $10,000 in buying and selling power. So what that means is you can basically just trade as if you have $10,000 as opposed to if you only had $1,000. The thing is 10-to-1 leverage is actually extremely low. What we want to be looking at is between the 100 to 500 leverage, which can be difficult depending on where you're located and what country you're in. As I said, I got some workarounds for that, and we'll see if we can figure that out for you depending on what country you're in. So your margin is basically how much money you need to have in your account to maintain that open position, as if it falls below that level, you'll probably get an email or something saying that you've been margin called. And what they'll do is they'll start canceling out your positions to maintain the level that you need to hold that open leverage position. Margin call, very bad. It's happened to everyone, so don't stress too much, but you do not want to get margin called. That means that you're risking way too much. We shouldn't be anywhere near a margin call. So I'm just going to put some random numbers out there. The math won't math right now, but I'll just give you an example anyway. Let's just say you have $10,000 and you've opened up multiple positions and it's gone down to $5,000 that you have left in your account, but the positions are still open. So your equity is 5,000, but your balance is 10,000 and you have a 50% margin. When it gets below that $5,000 mark, you will get what is called a margin call, where they'll email you and they'll either close out all your positions to maintain your safety, make sure you're not losing any more money, or they'll start cutting off a few of your positions, closing out 50% of them to maintain that level that you can keep them open with. That one's a little bit confusing. Screenshot this as well. Look into leverage and margin, and you get the hang of it pretty quickly. Okay, thank fuck, we're on to the funner stuff. This is basic market structure. I've kind of explained the bullish, upwards, downwards, bearish sort of stuff. So a typical market structure, what you get is up, down, up, down, up, down, up, down, just constantly up and down. It moves more like a wave than anything. Lightning bolt. Cool analogy, bro. So it's never really just up and down. Now, as you see here, this is more of an up and down market, but what we're looking at is a sideways trend. So it does these ones still though. It goes up, it goes down, it goes up, it goes down. So what we have here is called a range, consolidation, accumulation point. This is an upwards trend, downwards trend, sideways. Pretty straightforward. We'll move on to the next one. Okay, so this is the most important thing that you need to know about technical analysis or market structure, and that is support and resistance. You might have heard it before if you know a little bit about trading. It is extremely important. So resistance is up the top, support down the bottom. Now, why do we get these support and resistance levels? So as I showed you before with the buy limits and the sell limits and the sell stops, buy stops, what people will do, they'll put their buy stops and their sell limits and their sell stops and sell buy limits here. And basically what happens is it's a bit of a psychological level. So price is going to react at these levels almost every time. Now, the great thing about support and resistance is you can base your strategies just off of support and resistance. So you can just buy here, sell here, buy here, sell here. We have these mini support levels too. Should probably be using them as well, but these are more strong. You know, buy here, sell there, buy there, sell there. It's pretty straightforward. Obviously, you want to be careful of breakouts when a breakout will happen, which does happen, but there are also false breakouts. So it will pretend to break out, it'll take out a bunch of people's stop losses, and then it will just drive straight back down to where the last support zone was. Same goes for down too. You know, you'll get what seems, I mean, that doesn't really seem like a false breakout, but it can happen. Go down a little bit. It'll retest this level and then it'll just come straight back up, catch a bunch of liquidity in the market, and then straight back up to the resistance levels. Very important levels. If you go back in time, yearly levels, monthly levels, weekly highs, daily highs and lows, you will see lots of reactions at those levels, indicating people are buying and selling from those levels. They're putting their buy limits and their sell limits, sell stops, buy stops, and it creates these movements of support and resistance. Now, this is just an example. It doesn't always work. This is just a good example that I found to show you kind of how it works. So I just wanted to jump on a live chart and show you a little bit more in detail what these kind of support and resistance zones look like. Now, they are zones. It will never, or okay, it might, but it's almost never just to a point. So what you can do is you can draw a box. So that will be like a supply and demand zone. So you can do stuff like that that will indicate approximately where the levels to buy and sell are from. As you can see here, this is a breakout. It's retested this support zone and then it's broken out again down. It's obviously come down to a level down here, which I presume will maybe be, oh, get this shit off my screen. Maybe be a, this is a daily level, so I suppose this would be a support and resistance. Around about there, let's hit that, hit these lows down here, that low, that low, that low, and it's reacted and come back up. And there's some more zones here too. Anyway, that's pretty much that. Straightforward again, very important, very easy to understand, and very effective too. Okay, so now we're getting into indicators which help us identify good buying and selling opportunities. So you can use these in conjunction with your support and resistance levels that helps you get a bit more confirmation before buying or selling. So what this is called the Fibonacci tool. So these are pretty much the universal levels for the Fibonacci indicator. And what you'll find a lot of the time is it's going to react at one of these levels. Now, when do you put a Fibonacci tool on the chart? What you want is you want a large extension and then a pullback, and then you can kind of gauge what sort of level that you might set your take profits at. So let's just say we want to put in our sell here. So we've had a break of the previous candle's low and we've closed off underneath. We want to put our sell in here. What we do is we get the Fibonacci tool, we'd put it from the bottom of the move to the very top of the move, and then we would see these levels and we can pick one to set our take profit levels at. So we can also do partial take profits. So you can take partial take profits at the 23.6, partial at the 38.2, partial at the 50, and you can also maybe try and predict a big A-shaped recovery where you get back down to 100%, which does happen quite often. If you get these big news moves or something like that that aren't really necessary, you do sometimes get these big A-shaped recoveries that come back to the level that it was originally trading at. So this one here, obviously, it's come up, chucked the fib on, and it's come down to almost a perfect 61 retracement. It's tried to get up, which also just happens to be a resistance zone. So we've got two confirmations here that it might stop out at this level. What you could also do is chuck in a buy. A lot of the time resistance turns into support and support turns into resistance. You will get the hang of that as you look at the charts more. You will see these levels reacting more often than not, and you'll kind of understand how it works a bit better. That just comes with a little bit of time. You, again, just replay these videos if you need to. That's also going to help as well. I'll jump into the charts as well and show you a few more examples of the Fibonacci working. All right, so an example of the Fibonacci, as you can see, there's this big move, 21st of January. Yesterday, I'm guessing that was that was the Canadian news that came out yesterday. So there was this big move that came up. We put the Fibonacci tool all the way up there and it's reacting in between the 38.2 to the 61.8. Obviously, it broke down a little bit lower, but it has come back up and done a bit of accumulation there, a bit of a sideways move before retracing almost all the way down, which it probably, eventually it got back all the way down to the price that it was originally trading at. So a lot of the time that these big news moves happen, they do tend to retrace if they're not colossal moves, you know, Russia nuking the world or something like that, a lot of the time it just retraces back to the level that it was trading at. All right, so we're on to the next indicator that I personally use, and that is the relative strength indicator. So in short, RSI, this is one of the most old school indicators that people use, and it is extremely effective. So what it is it's this little chart down the bottom here, and what it does is it measures strength over time. So as the market moves up in a very strong direction, this will go up. I'm not going to go into the formulation of how it actually works. I can, but I'm not going to, because it's not going to make any sense to you. But just understand that we put levels where the RSI might react at, and a lot of the time it does, and you do get these big reversals. Again, I'll jump on the chart and I'll show you a few more examples of it working, and a lot of the time you do get these big pullbacks. All right, so we're on the chart. What I've done is I've set my RSI up to how I like it. So it's basically measured out of 100. A lot of the time people set it at 70 and 30. That's like the default settings that most people use. I like to use 75 and 25 as I like a little bit more of an extension before getting into my entries, as it's just a bit safer and you're less likely to have the direction move in the opposite way. So as we can see here, right there, which is about here, we have this extension on the RSI. Now, this has had a long pull up. So a lot of people are buying, There has to be a take profit move at some point. People have to take their profits. So what happens then, when everybody takes their profit, dumps a little bit more, you get more sellers jumping in, and you get this little dip in the market. Sometimes it can be big, sometimes it can be small and then continue up, but a lot of the time you'll find this happening. So another thing we can do once it's extended, which I don't really do, but we could put our fib up here and we can see that it's come down to at least a 23, almost a 38.2 retracement, and then it's continued back up. So again, you could do partial profits, have a trailing stop. So you can put trailing stops, which means that when you're in profit, the stop will move with it, which locks in profit. Make sure that you're not losing any money. So that's just an example of a trading strategy in general too. So you could use the RSI for an extension and then chuck the fib on once it's extended above the 75 level, or the 25 if you're going short. And then you can chuck your short in wherever it's first extended. You can put it in there, set your take profit levels, and then you've made some money. It's pretty straightforward. Welcome back to the Trading for Beginners Bootcamp course. Again, who gives a fuck what we call it? You are back, and that's what matters. Today I'll be teaching you about instruments, risk management, and psychology. We will then go on to platforms and brokers, and then finishing off with strategy development and strategy testing. And that should wrap up the Trading for Beginners Bootcamp. First thing we're going to look at is instruments. What are we actually going to be trading? Okay, so there's a lot of different instruments you can trade with. I want you to, if you've heard about them, forget. Don't worry about it. We're going to focus on these two. First thing I'm going to be talking about is currencies. I'm sure you all know what forex is, the foreign exchange market. If you don't, you're about to learn about it. So it is the biggest financial exchange market in the world, and there's about $6.6 trillion that goes through the forex market every single day. The forex market operates 24 hours a day, 5 days a week, so it is closed on weekends. Good for you if you don't want to trade on weekends. And there's a variety of different pairs that you can choose to trade with. So the most common and the most liquid currency pair to trade with is the euro versus the US dollar. So when speculating on which direction the market might move in, let's say, for example, the euro versus the US dollar, because the euro is first. If the euro is in a bullish market and it's going to be going in an upwards trajectory, then the market will reflect that and you will get these big bullish moves. Now, if the US dollar is very weak, you will also get these big bullish moves. If the euro is weak, it'll go down. if the US dollar is weak, it will go up. Pretty straightforward. You can test that on a couple of different pairs. Whichever currency pair comes first, if there is strength in that currency, it will be going in an upwards direction, vice versa with the second currency of the pair. So what exactly makes a currency strengthen or weaken? There are loads of different things that can make a currency go up or go down. The main ones we're going to be looking at are things like global economic events, which actually consist of quite a few things. So some things include interest rate changes, inflation, unemployment, recessions, pandemics, and even some currency pairs like the Canadian dollar is linked to oil. So if oil prices are going up and down, a lot of the time you'll see the Canadian dollar going up and down as well. Another thing that might impact whether or not the price will go up or down is also geopolitical developments. So stuff like wars, tariffs, as you've probably seen a lot in the news at the moment with Trump, with all these tariffs, that will make the market go up and down for certain currency pairs. Tensions between different countries and stuff like that, that can also impact the market. Just basic news events, and even things like, as I said, Trump coming into office, different changes in leadership and stuff like that. And the other thing is market sentiment. So basically traders like you or me, banks and institutions buying and selling the market. As I showed you before, the different levels of support and resistance, that can influence which way the market's going to move. Now, don't stress too much about this because I will have a advanced course on which currency pairs to choose, what strategies I'm using to make my profits in the market. So looking at the advanced course after you do all the basic stuff is going to be the best move for you if you want to be profitable. The next recommended instrument that I'm going to be touching on is indices. So an index or an index fund is basically the largest publicly traded companies or stocks into one large index fund that you can speculate on. So the goal of an index fund is for it to just keep grinding away and going up in price. As I said at the very start of the course, the S&P 500 has gone up on average about 10% per year. So you can trade long-term with these funds, and a lot of the time you will get great returns back. What I tend to do is wait for the market to open, and you tend to get lots of liquidity at the open, and it usually shoots up in one direction or the other. That's a little bit of an insight into the advanced trading course where I explain one of my strategies that I make money on. So a lot of the time, index funds will move in a similar direction to the currency of that country as well. There are a few different factors when trading with the indices and what moves it and what doesn't move it. Obviously, when certain different stocks have earnings come out, that can impact which direction the index is going to move in. Whereas currencies aren't really related to stocks, so they don't really move the same all the time. Other things like interest rates, geopolitical events, and obviously like your market sentiment, which how many people are buying and selling the index in the first place anyway. The reason why I like indices, as I said, is there is usually a strong initial liquidity where a lot of orders come through at the very open of the market, and you get these big moves that happen quite early and quite quickly too. So there are a few different ways that you can trade the indices. My recommendation is CFDs, contracts for difference. It allows you to use that leverage, whereas some of these other options you can't. Futures, options, ETFs, we're not going to be looking at any of those. You might hear them from other people. Cut it out. Don't even think about it. Contracts for difference are what we are looking at and what we're going to be trading with. Okay, so now we're going to be talking about risk management. Again, one of the most important things that you need to know about trading, as if you have no risk management, you're completely fucked and you will lose all your money. Now, a lot of your risk management, and in the next slide, we'll be talking about psychology, it's gonna come with time. It's hard to understand your risk management and your psychology when you first start trading. So I'll give you a few tips with your risk management. What you wanna do is you want to stick to your trading plan once you have one. Obviously, you're gonna have to test to see that if it's profitable. If you join the advanced course and you use my strategy, you're obviously gonna know that you will have a winning strategy, but it doesn't stop you from getting in your own head and clicking the buy and sell button when it is not necessary. If you're going to be using your own strategy, you need to use leverage extremely cautiously. If you put a massive order in, don't put a stop loss in, and it just plummets to the ground, you're in big trouble and you will either get margin called or you will lose a large chunk of your account, which has happened to almost everyone. When I was demo trading, it happened to me so many times, and I'm thankful that I demo traded because it allowed me to iron out all those kinks and make sure that it wasn't going to happen to me once I went trading live. Another thing is that you need to stay on top of the news. A lot of fucking idiots that I've seen out there and these trading freaks who say that you don't need to look at fundamentals in the market and you can only trade off of technical analysis are fucking morons. That is not true. You need to know what's going on. Briefly, the major news events you need to know about when trading currencies and trading indices and trading in general. You could be completely oblivious to something like a large interest rate change or inflation numbers coming out, and you decide to put in an order 10 minutes before that happens. Riskiest and dumbest mistake that you can make is not staying briefly up to date with what's happening in the news. And I'll give you guys some websites that you can use that will give you these big news events and the times that they're going to happen, so as you can stay briefly on top of what's happening around the world for the currency pairs that you're trading with, or indices for that matter. Now, again, if you're in positions and there are big news events coming out, or there's something that's been happening around the world, like a war's kicking off or something, you may need to adjust the strategy and maybe hold off from trading for a little bit on certain currency pairs. I will teach a little bit later in my advanced course about when to kind of do that sort of thing and what currency pairs or indices to stay away from when big news events are happening, or wars, or, you know, Trump coming in, putting in tariffs for different countries and stuff like that. I'll give more examples in the advanced course. This is just the complete basics. So sometimes you may need to adjust your strategy to cater for those sorts of things. Now, this is great that I touched on this before as well with the forex market and the indices, is you don't want to just be riding everything on one single currency pair or just the S&P 500. What you want to do is you want to diversify the portfolio or your investments or your trading into different classes and different instruments, so you have exposure on a larger variety of instruments instead of just one thing that can cause psychological issues and stress if it's going in the wrong way. Whereas if you're in multiple different markets with lower risk, you can stress a little bit less when things start to go in the opposite direction. So this is one for kind of when you're starting out, is you don't want to be risking more than 1% on any of your trades. In fact, to be honest, when you're first starting out, if you're using your own money, I would do 1/3% maximum. Obviously, the returns are going to be quite minimal, but also the losses are going to be quite minimal because you're going to be making a lot of mistakes when you first start trading, especially if you're making up your own strategy. What I recommend, joining the advanced course, and then I'll give you more information, so you probably won't need to worry about that one. And if you do get a loss, but you do have a proven strategy, don't start hitting the buy and sell button to try and recover the losses. If you have a proven strategy, why is it not going to continue to work? You may have a loss. That doesn't matter. We all have losses. It's the cost of business. I cannot stress this enough. Do not be tempted to get in your head and try and recover losses. Most of the time it's not going to work, and then you're just going to end up in the hole more. You're just going to lose more. Now, trading psychology, extremely important. Most trading gurus and trading fucking bullshit experts don't really talk about your psychology. A lot of the big losses come because you're in the wrong psychological place and you're usually over leveraging and just making fucking mistakes that if you were clear-headed and had a good psychology, you wouldn't be making those mistakes. A lot of this is basically what I talked about in the risk management. You need to trust your trading strategy As I said before, if you have a proven strategy that has worked in the past, it's most likely going to work in the future. And if you have a few losses, don't stress too much. You have to be level-headed and you have to be open to learning so you don't make reckless decisions. If you decide to demo trade first for a period of time, you have to understand that your trading psychology when demo trading is a completely different beast to when you're actually live. So I demo traded for 2 years before I put a cent of my money in. The second I started to put money in, I thought I had my psychology sorted. I was sweet. As soon as I put my own money in, I started making these silly fucking mistakes. I started doing a few over leverage and revenge trading here and there, and I made a few mistakes. I didn't blow any accounts or anything like that, but I definitely would have made a lot more if I had the correct psychology. So even the best, even the most demo trading in the world, your psychology can still change when you decide to become live, and you might make a few little mistakes here and there, and that's okay. As long as you learn from those mistakes and your psychology continues to get better, then you'll be fine. Obviously, sticking to your trading plan, as I've said about 500 fucking times, I cannot stress this enough. The other thing I'm going to mention on is just full on avoiding trading if you're in like a serious emotional state. Now, I'm not talking about if you've just had a shit day. I'm talking about breakups, deaths in the family, big shit like that. You just want to stay away from the charts. If you get too emotional, it's your money on the line. If you've had some fucked up shit happen in the past week, it's probably best to just cool off, give it another week, give it a couple days until you think that you're in the right headspace to be playing with your money again. The market's not going to go anywhere. You might miss a couple of big moves, but there's always going to be more big moves. You just need to take a break when the big shit happens. Welcome back. Thank God. Last episode in the Trading for Beginners. Don't make me make a fucking name for it. Whatever it is, this is the last episode. Congratulations if you've gotten this far. You're doing a great job. Hopefully you've learned a lot. Let's get stuck into this one. Now, what I'm going to be teaching you in this one, we're going to go through platforms, brokers, strategy development, and then we'll finish it off with strategy testing. So let's not fuck around and let's get straight into it. We'll start off with platforms. Now, earlier on in the course, you've seen me use a platform for charting and looking at different candlesticks and patterns and everything like that. That was on MetaTrader 4. Now there's so many different platforms out there. It can be pretty confusing. I would suggest that MetaTrader 4 and TradingView are kind of like the Nike and Adidas of trading platforms. They're the most popular ones that people use for day trading. Now my personal recommendation is MetaTrader 4, but I actually originally started on TradingView. Now, if you start on TradingView and then go to MetaTrader 4, it's like you go back 30 years in time. It took me a little bit of time to get used to it, but I found that MetaTrader 4 is so much better for the way that I trade because a lot of it is used with robots and algorithmic trading. TradingView just didn't offer me what I wanted with a trading experience. So I basically just completely cut them off and went to MetaTrader 4. So the reason why I like MetaTrader 4 so much is kind of how they utilize the expert advisors, which is a trading robot, and how easy it is to set them up, and you can even build your own for free. Now, everything on MetaTrader 4 is completely free compared to TradingView. We'll get into that. It is not. Another thing with MetaTrader 4, it being so old, it runs on pretty much any computer, most phones, it runs on completely fine. Like you won't have any troubles with an older system. It's not very demanding for your devices to actually use it, but it still is an extremely effective platform. Now, obviously it's very safe as well. As I said, these are like the Nike and Adidas, so they've got extremely high level encryption and they got, secure login protocols and everything like that, or your two-factor authentication bullshit and all that stuff. So you're pretty secure with them. The other thing is you have the MetaTrader 4 app. They did remove it off of the Apple store for quite a while, but it is back now and it works great, and I use it all the time. And a lot of the time when you see the screenshots from people showing their account balances and whatever with the shitty, dumb, fucking fake trading gurus, is that's on the MetaTrader 4 app. So they screenshot their shit. I do it too, and I send it into the Discord group of the profits and losses for the week, the days and everything. That's on the MetaTrader 4 app. So you can get it on like a tablet if you have an iPad or like a Samsung tablet. You put it on your laptop. They also have a website as well. They have a web version of it. I don't use that, but you can use that on a web version. Now, TradingView. TradingView is very good if you want like a sleek design because it looks really new. Obviously, they keep it really up to date. Looks fancy. You only need the web version. You don't need to download an app or anything if you're using it on a computer. Obviously, if you want to jump on your mobile phone, you can as well. I used to have the app. It looked good. It was functional. One of the main things with TradingView is that you got to pay for shit, and MetaTrader 4 is free. I'm not paying for fucking TradingView when all of my expert advisors and the best algorithmic trading platform is MetaTrader 4. I'm just not gonna dive into that, and it's a lot more complicated too. Like with the free version, you can only use I can't remember, it was like 3 indicators or something like that. If you want to use more, which I use personally like 7. It sounds a lot crazier than my charts actually look, but I have weekly highs and lows, daily highs and lows. They're both separate indicators. Your RSI, that's a separate indicator. So I use quite a few different indicators to help me get in and out of positions. And with TradingView, if you only get 3 for free, it's pretty shit. Good thing though, if you want TradingView with my broker, you get it for free. You get the TradingView Pro for free. There are high, that's the first paid level, then there's the second, third, fourth, they do a million different fucking things. But if you want that, click the affiliate link and you can sign up and you get TradingView Pro for free through me. So yeah, if you want to use TradingView, you can. I'll quickly show you TradingView as well, just so you get a better idea of it. All right, so this is TradingView. I hope you enjoy this because I'm absolutely obliterating my retinas looking at this shit. So they do have down to 1 second, 5 second and everything, but I'm pretty sure these are paid. So you got to pay for it. We can go to lowest is a minute, 5 minute time frame. It is obviously a much better looking platform than MetaTrader 4, and it's, runs smoother. Honestly, don't really like it because you gotta pay for all the good shit, whereas MetaTrader 4 is just all free. And expert advisors work a lot better on MetaTrader 4 than they do on TradingView. A lot of people use this shit. If you're just manually trading, it's completely fine for you to do that, but I just would recommend MetaTrader 4, especially if you're going to learn from me. If you're using a different platform, it's going to be a little bit more difficult to keep up with everything if you're looking at something that's a completely different platform. Whereas if you're just copying exactly what I do, that's completely fine, and it just visually makes it a little bit easier for you. And I can give you way more tips from MetaTrader 4 than I can with TradingView because I only use this for fucking 3 months or some shit 4 years ago. So yeah, not too familiar with the platform. I can't tell you too much about it. Only that I recommend MetaTrader 4 for the 500th fucking time I told you. Okay, let's go on to the next slide. All right, brokers. On to the next one. Now, there are a fucking shitload of brokers and so many of them suck. I have tested and tried and been with so many fucking brokers. It's actually fucking unbelievable. You should see my spam email that I have that I threw all the fucking brokers into when I was testing them all. It's fucked. And a lot of them are really shit. And some of them are quite unsafe too. Now, when looking for a broker, one of the most important things you need to take into consideration is the regulation and security. You just want to have one that's regulated with like a reputable authority. So in Australia, you got the ASIC, then you've got all these fucking other authorities. If you're going to go down your own route with regulations and shit like that, just be careful, because you might get fucking hell, just take my recommendation. I've done it all, but if you want to, just make sure you're looking for one with a reputable authority and you'll be fine. Leverage, obviously we've gone through leverage earlier. Leverage is extremely important with trading. If you don't have enough leverage, you won't be able to put enough lot sizes in, and your trading will be fucked, okay? Your trading will be fucked. You can't put enough positions in if it goes in the opposite direction, which I teach in the advanced course, which you will get to hopefully. You want minimum 1 to 100 leverage. Depending where you're based, that's most likely going to be extremely difficult. If you DM me on Discord with what location you're at, I can probably give you the best recommendation. If my 2 recommended brokers don't work out for you, then DM me. I'll give you a few other options that you can choose from, make it a little bit easier for you, because I've done this with fucking all the brokers that are out there. So shoot me a message, I'll reply to you if you can't get a broker with 1 to 100 leverage, which for Americans, I'm about to explain one broker for Americans that doesn't have 1 to 100 leverage, but you can, I kind of gotta tell you that that's the broker to go for. So just DM me on Discord and I'll give you some options. But yeah, obviously you want one, but most brokers have most asset classes. So, stocks, ETFs, forex, some have crypto and shit, but who the fuck trades crypto on MT4? With what we're going to be trading for, we're going to be completely fine with any pretty much standard broker. Obviously my recommendations are going to be completely fine, but yeah, if you want to do your own research or try and find your own broker or some shit, go ahead, good luck. But just make sure obviously they've got the correct shit that we're going to be trading, which is obviously indices and forex, as I explained. Customer support's pretty important. If you have a problem, which I've never really had a problem with my broker ever, but I have contacted customer support a couple of times. It's like instantaneous, they respond to me, so it's pretty good. Obviously you want one with decent customer support, otherwise it's just, if you have problems, you can't be in trades and having problems and not being able to contact customer support. You're gonna get in a lot of trouble, and if it's going in the opposite direction as well, don't really want to be doing that. Now, commission and fees. Some brokers are going to charge you a commission. Some have zero commission. Some have larger spreads. So your spread increases, and that's kind of where they make the money instead of the commission and shit like that. So most brokers will have different account types that you can choose from. I can give you the recommendations for my broker. I can't speak for other brokers because I can't remember them off the top of my head. But yeah, try and get as lowest fees as you possibly can whilst getting a reputable broker, making sure that you have the assets and especially the leverage. Leverage, super important, which is where I went down the rabbit hole of trying to find a fucking broker that had all of them. I was trying to get the lowest commission and shit, and it's virtually impossible to get absolutely everything that you want. That's where I landed with my broker. Now, my broker, Black Bull Markets, they are so good for what I need. So they're regulated by the FMA of New Zealand, which is the financial market authorities for New Zealand, which I don't even fucking live in New Zealand and I can use them, which is great. We love that, which allows me to use high leverage, because in Australia, we're capped with their ASIC of 1 to 20 leverage on the indices and 1 to 30 for Forex, which is fucked. It is completely fucked. So shit. So Black Bull Markets, fantastic. And they're also regulated by the FSA of Seychelles, which is fucking, it is what it is. Another authority, sweet. So you got a pretty secure trading environment for yourself. And I've never, ever, ever had an issue with Black Bull Markets. Now, leverage, obviously, I get 1 to 100 for indices, and I get up to 1 to 500 for Forex, which is fucking great. Fucking great. That's all I need. Don't need any more than that. Don't need any less than that. Perfect. 1 to 100 for indices, mint. 1 to 500 for forex is shitloads. So I'm completely fine with that. Perfect. No issues there. No hidden fees, obviously, with pretty much most brokers. There's no really anything dodgy. They disclaim everything on their website that they charge, which is fuck all. And obviously you got 24-hour, 5-day a week support too, which if you speak different language or some shit, makes it easier. They got multilingual support as well. And I prefer the live chat so much quicker. Do email you sometimes if you want to go that far, but usually the live chat's fine and clears everything up pretty quickly. Now, this one is very difficult because it is hard as fuck to get a broker for US and Canada. It's fucking hard. It's like banned in the US or some shit. So this is the best that I can come up with, that's fine for you US traders. Again, DM me on Discord if you need other options with high leverage. 1 to 50 is okay. It's usable for indices. For forex, you're going to be struggling a little bit, but indices, it's going to be fine. We can work with the 1 to 50 if you want to stick with Oanda because they are pretty reputable. They are registered with the CDFC and obviously NFA. You've got strict regulations, but these guys comply with them. The other thing with US clients, real fucking weird, is that you need to deposit with most brokers, if you actually want to be able to trade in the US, is you got to fucking deposit like 20 grand or some shit, which I think is pretty fucking ridiculous. So there is no minimum deposit. So you guys can just chuck whatever the fuck you want in. I am affiliated with Black Bull Markets because I chose to be affiliated with them because they are my fucking broker that I use for ages. This isn't biased. I just thought I'd set it up anyway. Not affiliated with Oanda. I don't really give a shit. If you guys want to use it for you US cunts. I don't really care. Now, obviously, I did quite a bit of research on Oanda before choosing them, and there weren't any hidden fees or anything. I did set up an account with them as well, just to make sure that everything was sweet. Did a lot of research to make sure that it was okay. Did a bit of trading with them, was completely fine, no problems at all. Obviously, for US traders, you're going to be sweet with them too. And of course, it's pretty standard with the pretty good brokers, 24/5 multilingual support too. And I had a little chat, it's pretty good. So yeah, you guys will be sweet with Oanda. If you're US, Canada, around those areas, you'll be fine. It's a good broker. Just the leverage is fucking shit. So this is pretty much wrapping it up. You've got pretty much all the knowledge that you need to start trading. Now with strategy development, again, if you don't want to go through the whole process because you are going to get absolutely fucked if you try and create your own strategy, just join the advanced course and I'll teach you exactly what I do. You'll get a proven method with proven results and you will essentially, hopefully, start making money from the get-go if you don't run into psychological issues. But if you do want to develop your own strategy, by all means, go for it. With a strategy, 3 things you need. Entry criteria, you need your risk to reward, so you can calculate that. I'll put the links, I'll put broker links, and I'll put calculations for lot sizes and risk to reward, all that shit I'll put down below in the description. And you need to make sure that your psychology is on point. So that's pretty much it. You can create a strategy out of thin air, essentially. So entry criteria, risk to reward, and psychology. Now, strategy testing, MT4. No, I didn't even put anything else in this fucking slide because I'm just going to explain it. Can go onto TradingView. You got to fucking pay to use their strategy testing shit. What I recommend is finding an expert advisor or a robot, especially if you don't have much time. Like if you can't sit on the charts for fucking 6 hours a day, 4 hours a day, find a robot that's gonna get you into the entries for you. What you can do, I'm just gonna jump on the website real quick after this is if you choose MT4. Okay, so this is kind of getting into my shit now. MT4 is where you should go. Again, if you've got fucking questions, join the Discord, put them in the comments below. wherever this is going to be in my Discord anyway. So here is MQL5, which is like the marketplace for MT4, which is where you can buy people's, like you can buy their robots and shit. I wouldn't fucking spend money on any of these, to be honest, but yeah, and you can also copy people how they, I mean, I wouldn't trust a single fucking person that does this shit either, but I mean, fucking, yeah, go for it. So let's just say you want to, you obviously got to log in, you got to create an account and shit after joining a broker on MT4. You then come over to here, log in. Let's just say, I mean, fuck this one, whatever, who gives a shit? We'll just click this. So you can do free demo. So you click on free demo. Oh, fuck, that's an MT5. Shit, hold up. MT5 sucks, don't use it. Okay, now we're back. So let's just click on the first one. Who gives a fuck? Nobody's paying 1.5K for a fucking EA. That's insane. But you can basically just try it. So you free demo. Yes, I have MetaTrader 4, or you can just download it here. I recommend going to a broker first, getting a brokerage account with them, and then going to MT4 and testing a strategy. You can, again, demo accounts are a thing. Set up a demo account. You have fake money, all that shit that you can use. I don't even fucking remember if I touched on that earlier. I think I did. If not, again, just ask me and I'll fucking tell you whatever you want. So you just go free demo, click on that. Yes, I have MetaTrader 4. It'll open up your MetaTrader 4 and you'll be able to select a couple of months depending on how much data your broker has, and you can test the strategy. You can just put your inputs in on how you want the strategy to work. It's really, really fucking easy. YouTube some shit, some tutorials or whatever if you need it, or just ask me. And yeah, you can just test these strategies. Test. That's what I did for 2 fucking years. I tested, and then I got a demo account and I just traded with my demo account. And yeah, that was pretty much what I was doing for 2 years until I found a strategy that I liked. I found a robot that did it, and I just tested it for a very long time until I was confident with it and it's proven to work, and I jumped in and I've been profitable ever since. So yeah. All right. Congratulations. You're done. This is the end of the trading for beginners, whatever the fuck you want to call it. You've done well, obviously, to make it to the end of this. Hopefully you've learned the complete basics. I tried to make it as simple as possible. Obviously, there is a shitload more that you need to learn about this stuff, and I'm happy to help you out with whatever the fuck you have. Just message me in Discord. It's completely free. You don't have to pay to get into the Discord. So jump in. I'll help you out. You have questions, leave it in the comments, whatever the fuck you need to do. That's completely fine. So I'll leave it there. Keep an eye out for the advanced course. That's going to be coming out soon. It might even drop by the time I release this. So just keep an eye out on the Discord, and I might drop that, which will give you the tips on absolutely everything that I do. I haven't recorded that yet. Might take me a little bit of time to do that. Keep an eye out for that, and good luck. And I'll see you next time.